So we've got 46 currencies in total. 36 of them are floating, and 10 of them are pegged or fixed regimes. So this potentially limits our opportunities to 36 currencies in the market, because the pegged or fixed regimes mean that the currency value is controlled by the central authorities within very tight specific ranges. What do we mean by that? Well, the central authorities themselves intervene in the currency markets, and they make sure that their currencies stay at a certain value. Now, as we talked about earlier, with asset prices staying at the same price, we use the euro-dollar example. If an asset price stays at the same price constantly over any time horizon, so 1 day, 1 week, 1 month, 3 months, 1 year, and we buy and sell that asset at the same price all the time and pay to do so, we simply can't make money because there is no volatility. This is the same situation with pegged or fixed regimes, because they stay at the same price every day, every week, every month, every 3 months, every year. Therefore, we know as traders there's no volatility and no opportunity to make money, unless, of course, the central authorities decide not to continue intervening in the currency market. But as traders, we're not going to, for example, sit here for 5, 10, 20 years and just watch a currency every day trade at the same price, waiting for something to happen. We need to just segment by volatility and opportunities and focus on where the opportunities are on a consistent basis. So what we find is that out of these 36 potential opportunities, 17 of these opportunities are floating currencies that are ex-commodity floating. So they're non-commodity currencies, meaning the countries don't have significant exposure in their exports to one or a multitude of global commodity prices. 19 of the floating currencies, 19 of these opportunities, are what we term as commodity currencies. So the countries have got significant exposure in their exports to one or two commodities. What we also find is that 4 of the currencies have significant commodities exposure. So the ones that do have that exposure are G10 currencies. So G10 as defined by investment banks and retail brokers. So they're developed. They're quite large economies. All LATAM currencies, Latin America currencies, they're floating, and there's the Latin American countries. There's no Latin American countries that don't have significant exposure to commodities. The only EMEA countries that have pegged or fixed regimes are GCC countries. And we also find that Denmark is the only developed economy with a pegged or fixed regime. And the DKK, the Danish kroner, is pegged to the euro. What else do we notice about our opportunities when we segment in this way? Well, we find that the Hong Kong dollar and the Singapore dollar are the only Asian currencies without significant commodities exposure. So they're pretty diverse. The only ones that without significant commodities exposure that actually have a pegged or fixed regime. The Chinese yuan is the only commodity exposed currency that has a pegged or fixed regime outside the GCC, and that's pegged to the US dollar. And the Sing dollar and the Kuwaiti dinar are the only pegged or fixed regime currencies that don't disclose the weightings of the currencies they are pegged or fixed to. So here we've got our 36 currencies, our 36 potential opportunities, and We've put them all on the same page here, so it's easy for you to view. Here we've got Forex markets floating. Well, that's actually non-commodity floating. So what we've defined as floating regimes that don't have significant exposure to commodities. And then we have Forex markets commodity floating. So these are our 36 opportunities. And these are the ones that we're going to basically have to not consider as volatile opportunities. So we have here the X commodity pegged, which includes the Danish krone, the Hong Kong dollar, and the Sing dollar. And the commodity pegged currencies. So these are the ones that are not going to move. There's no volatility, or volatility is extremely small.